Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Douglas Kiersey. Doug is the president of Dermody Properties and oversees all of the company's operations and strategic initiatives, including capital formation, acquisition, development, and investment management activities. He's a member of the Dermody Properties Advisory Board and chairs the company's executive and investment committees. Since Mr. Kiersey has joined the firm, Dermody Properties has developed and acquired industrial logistics assets with an aggregate value of more than $5 billion. Mr. Kiersey has more than 30 years of experience in logistics properties in more than 20 major U.S. markets. He is a member of the Urban Land Institute and the Society of Industrial and Office Realtors. And in just a minute, we're going to speak with Doug Kiersey about the intersection of work from home and e-commerce. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Douglas Kiersey. Welcome to CRE PN Radio.
Darren, it's great to be with you this morning. Thanks for having me.
Well, I'm really looking forward to our talk. As we spoke before we got started here, that we have a mutual connection there. And I got to say this to you. Congratulations to the Beavers, the Oregon State Beavers, as your alumni there, that they've had a great season. And looking forward to bowl seasons. That's good.
It makes me and my family very happy. And so it was a wonderful weekend for us Beavs.
Yeah, go Beavs. Before we get started, though, if you could take just a minute and share with the listeners a little bit about your background.
Sure, I'd be happy to. As it happens, I was born and for the most part raised in the area of Portland, Oregon, in the suburbs of Portland. Attended Oregon State University and went into the real estate business as an industrial broker with Cushman & Wakefield in the early 80s. And after 11 years with C&W, joined a then fledgling real estate investment trust called Prologis, which is now the world's largest owner of logistics real estate. I pioneered Prologis's entry into the Northwest markets in Seattle and Portland, and then moved my family to Chicago in 1999 and was given a bigger territory to run. Ultimately stayed at PLD for 17 years, and 11 years ago, I joined Dermody Properties. So I've been in the industrial real estate business now for just about 39 years.
Well, it sounds like you've certainly seen a lot of change. It's so funny you say Prologistics, and like I said, they're the leader, and it sounds like you were there in the beginning. Is that right?
Pretty close to the beginning. I think when I joined the firm, we had about 12 million square feet. The firm, I believe, is something close to 1 billion square feet now. So I learned a lot along the way and how to grow a company, formulate strategy, and execute that strategy. And I've been very fortunate to be able to put some of those lessons to work now with a private firm.
Oh, that's great. Well, let's jump into this a little bit here, and I think one of the first things that I'd like to ask you and have you speak to is just, can you define what logistics is? I think a lot of people have some sort of a rough idea, but for this conversation, is there a definition of how or what we should consider?
Well, for the benefit of your listeners and for this conversation, we should define logistics as the movement of goods from their point of origin all the way through a network of transportation and warehousing until it comes to the ultimate consumer. That consumer could be a household, or the consumer could be a business. So you have both B2C, business to consumer, and B2B, business to business logistics. And
Got it.
where we fit in that as an intermediary is providing the brick and mortar to support the distribution networks of our customers.
Okay, and in the brick and mortar, then, is that primarily warehouse?
It is. It's almost
Okay.
what we do is exclusively warehouses. I'm trying to coin the phrase logistics real estate. If you say industrial to some of our compatriots in Asia or Europe, they look for smokestacks. We say industrial in the US as kind of a catch-all for both warehousing and manufacturing. But logistics real estate is really our focus. It's our sole focus. And we spread across most of the major markets in the US.
And as such, are you developing, managing for others? Are you buying existing? How are you?
So what we do is we act as a fiduciary for our investors, which are a mix of domestic, Canadian, and European institutions, pension funds, insurance companies for the most part. We aggregate those dollars into a large bucket, what we call funds. And then as a fiduciary, we go out and invest those monies, those equity dollars, in both acquisition and ground up development. Over the course of the last cycle, that mix between acquisitions and development has skewed towards development as risk-adjusted returns have become more favorable on the supply and demand side. And so as a landlord and a developer, we've had quite a bit of pricing power over the course of the last cycle.
Got it. And that you mentioned the last cycle. Is that how long of a timeline do you consider in a cycle, and are there any specific events or situations that define that?
Well, if we go back to the great financial crisis in 2008 and 2009, I think most would consider that the cycle, the upswing in the real estate cycle, started in 2010, continued through the beginning of the pandemic, and then really was turbocharged by the Fed's activities as they took interest rates on a real basis below zero and on a nominal basis close to zero, which expanded the values of real assets. So that now has come to an end as of this last spring. And I think all your listeners have followed the Fed's actions. And so that's that's become some turbulent waters for real estate investors and investors in other assets caused by the increase in interest rates. And so I think most of us would consider that the upcycle, if you will, in valuations ended sometime this spring.
Yeah, no, I think that's fair, and I think everybody's trying to gauge what is the value based on where things are at, based on interest rates, and for the longest time, all I heard was cap rate compression, cap rate compression, cap rate compression,
Mm-hmm.
and I think we're starting to see a little change in direction on that. Let me ask you on the development side of things. You mentioned that you raise capital through institutional sources. When you develop something, is it leveraged, or is it all investor capital, or how are you?
So we have a subscription line that's secured by the balance sheets or the contributions of our investors into the fund. It's floating rate debt, so we'll typically buy the land on using the subscription line, and then as over the course of a very few months, we'll put construction debt, typically loan to cost of 50 to 60%, and the balance will be funded by equity. So if you think of a typical project being 40 to 50% equity and the balance debt, that's typically bank debt that floats, has a 3-year term and a couple of option years if we make certain certain leasing hurdles.
Got it. And on the development side of things, what is a typical timeline for identifying a site to have an actual lights on and people operating inside? Is that a short timeline or fairly
Well,
lengthy?
it used to be rather fast from the time that you would conceive a project, but now the entire cycle has extended. And so as we move into infill areas where entitlements are a little more challenging, we talk about that probably at some length around the logistics center. But then we've all read about the supply chain challenges. I've never known so much in my life about roof fasteners and electrical equipment and dock levelers, because every time we turn around, it seems that something is in short supply. And that condition has lasted over the last couple of years, and it's starting to abate. So as a consequence, what used to be from start to finish, perhaps a year to 18 months, now can be from the time we conceive a project and secure a contract on the land, now can be 2 to 3 years.
Wow. I think that's one thing that I don't think people really, grasp when they think about real estate. If you're, residential oriented, you see the sign in the yard, you go grab the flyer, make an offer or something like that, and you can move in, or there's a builder, or even if you have, ground, it seems like there's a relatively short window. But on these larger projects, just the timeline there. And speaking of the projects, what is an average size of a facility that you guys are developing?
I think our average size facility is somewhere around 250,000 feet. The minimum might be closer to 100, and the maximum would be close to 1 million square feet. But if you took the average of the properties that we have, I think around 250 would be a good number.
Got it. And as far as the size of the facilities, is that something that's grown over time? Is it continuing to grow? I mean, 1 million square feet sounds like a lot of. I mean, that's a pretty significant structure there.
Well, it is. When you walk into a building of that scale and look around, it's absolutely massive. Building sizes have grown as our customers seek to squeeze efficiencies out of their supply chain. However, as you move nearer to the core of the city, as we like to do in these infill locations, they tend to be a little bit smaller. So those two forces are working sort of against each other. In what I would call the outer suburbs or the exurbs, buildings are still trending larger. In the inner suburbs or the actual urban core areas, they tend to be smaller because the sites are smaller.
Got it. And as far as the locations, you mentioned kind of the more towards the infill as opposed to the outer limits. Are the facilities you're developing, are they single occupant, or are they multiple tenants, or is it?
But we build flexibility in the buildings for current or future multi-tenant use. And so the designs with respect to where you have the entries and the level of dock doors and the parking and your utilities and so on, you want to make sure you have the flexibility to lease to multiple customers, either in the first generation of leasing or as you relet the building downstream. Having said that, a lot of our buildings end up as single customer buildings.
Well, and just as a concept, I mean, when we speak of logistics, and in my mind, I've got a warehouse with several dock doors and trucks pulling up and unloading and loading, and you guys are the brick and mortar piece in that, but the people moving in and out and all the stuff. I'm thinking Amazon, FedEx, UPS. Is that kind of the one of the types of occupant that would be a potential tenant for your building?
Well, of course, like other providers of logistics real estate in the U.S., Amazon has been a huge customer of Dermody Properties, and they're a great customer. and our relationship with them remains very strong. As you may know, they've announced recently that they're going to pull back a bit on their absorption of new space, kind of digest what they have, if you will. They've even talked about subleasing a handful of facilities, but at their peak a couple of years ago, they were absorbing something like 20 or 25% of all new construction of logistics space in the US. And so they're a massive customer for us and for our competitors. The other names you mentioned, FedEx and UPS. So that vision that you have around local deliveries is one of the segments that we play to. There are some others that are a little bit less truck intensive, a little more interstate in nature. So we work with customers that want last mile facilities. We work with customers that want middle mile, and we work with customers that are focused on regional and super regional distribution. So we span across that entire continuum.
So you kind of the different distance points you mentioned, last mile as opposed to inner and or I don't remember exactly the phrase you used there, but the kind of the difference on the distances there.
Mm-hmm.
How has that changed? Because when I was preparing for this and I was kind of thinking through as a kid before the internet, there was the Sears Christmas wish book was kind of like this thing that was like, I can remember like looking at something and like, focusing on it and letting Santa or whoever know that that's what I wanted. And I can remember like we'd go to Sears to pick up that last piece. And I was thinking about it just from a standpoint of, Sears is pretty, I don't know if they're still in business. I know the mall where I bought every pair of jeans and tennis shoes growing up has been destroyed, demolished and repurposed now. I think it's a Lowe's or something like that.
Mm-hmm.
But it seems like in the model of distribution, it was a fairly significant last mile receptacle there. Now with like the Amazon and FedEx and all of this, the ability to just order something on your phone and have it show up here and sometimes the same day. Is that part of? Am I thinking right as far as some of the change in the way that the distribution of products to the consumer has evolved?
It's been a massive change over the last 10 or 15 years. And the pandemic was an accelerant to that cultural change, or that secular change, I should say. It's also a cultural change in how we bring goods into our home. I'll give you another name to date myself, Montgomery Ward. So you could say that Montgomery Ward and Sears were the original e-commerce companies. Throw JCPenney in there as well back in the day. And but what these companies want now is they want to compete. And when I say these companies, e-commerce, but also the omni-channel retailers. So the Walmarts, you mentioned Lowe's, the Home Depots, et cetera, the Tractor Supplies. They want to be able to compete based on their ability to deliver to the customer. They don't want to compete based on price because that puts downward pressure on margins. So they've all been racing to optimize their supply chains. And the last mile piece is the hardest piece because the barriers to entry are very, very significant. So we focused a good deal of our energies on identifying sites that serve last mile needs of our customers. And that means we've been involved in a lot of, you mentioned repurposing. You mentioned a mall becoming a Lowe's. Well, now, we're tearing down and full-on corporate office campuses and replacing them with logistics. We demolished a General Motors plant. We've demolished a Dean's Foods milk processing plant. So there is sort of a great repurposing occurring across real estate, and we'd like to think that we're sort of at the tip of the spear of that.
It's funny because the repurposing, there's different levels of repurposing. I think a lot of times of just the occupancy of the structure from A to B or office to warehouse, or I know like I've seen it happen here recently where like some of these larger retail single occupant buildings have changed to either another retailer, which is not really, that's just like re-tenanting the building, or storage, self-storage or something like that.
Mhm.
But the actual just coming in and raising a multi-hundred story or 100 square thousand feet uh, retail mall, and then coming in and building something new. It's just like, I'm going, wow, is it's just hard to comprehend that in my lifetime, something that was brand new and was the place to be
Right.
has fallen out of favor so much so that, like, oh, knock it down, let's build, put a Lowe's there. And but I guess I mean, if that's what it comes down to, if the demand is no longer there and there's no value in the structure, the way that it's configured, and the land has value, you know, come in and repurpose the land. And I'm assuming at that point it's more about the location of the land that's a value to you, and that last mile concept.
And so the number of households that our customers can reach within a certain radius of the facility and the demographics of those households, that all becomes part of the mix in terms of whether a site is attractive for one of these sorts of facilities. And so we spend a good deal of time doing research around those metrics. But you hit on something else, and that is that this change really relies on the cooperation of the municipalities, because in states where there are sales taxes, which are most states, when you lose a retail tenant or even a mall, and you replace that with something else, that local municipality is losing that tax revenue that they've relied on for years. So often there's the tension between the reality of, hey, this mall's been vacant, it's an eyesore, versus, well, we don't want to lose that as retail land in our community, because once that tax revenue goes away, it never comes back. So that's part of this transition, if you will. And I think everybody in their own community can probably point to one or two notable projects, as you suggested. When we grew up, there was a mall there, and now it's something else.
Yeah, no, and it is just kind of a weird thing when, I mean, how fast it happened, I guess, is kind of the thing. I mean, maybe it's just I'm getting old, but uh, the fact that something could be something that was such a pillar of the community, and now it's like, we're past that. Let's move on. It's kind of it's more hard for me to recognize, I guess, as somebody that spent a long time there. Um, but as far as the logistics, I guess one of the questions I have: how big is the business of logistics? In from manufacturer to consumer and all points in between. Is there a percentage of the GDP, or is there a number that just as because it just seems like when I start to think about all the different points, from the manufacturer's location to whatever the regional warehouse might be, to the ends of the spoke, and then that last mile thing. I mean, it's a big part of the economy, is it not?
It's massive. And that's a really great question. I wish I had a specific answer for you, but I don't. But as you think through the, consumers being 70% of the economy, of the economic activity in the US, and that everything we touch or look at in our office or our home or wear came out of a warehouse at some point in time. I'm sitting here looking at my Fiji water. I mean, that was in a warehouse a week ago somewhere. And so when you talk about the trucking industry, the railroad industry, the warehousing industry, and all of the players that go along with that, the shipping business, it is a massive part of our economy, and it's a growing part of GDP. And it's a growing part of the labor force as well. And if I could make a point about labor, these aren't the forklift jobs that we maybe have in our mind, although there's still plenty of that. When I walk into an Amazon building, and I'm not saying anything out of school because they're publicizing this, but they're starting their people at something in the high teens to low $20 an hour. wage, with benefits, with the potential to earn college tuition, with flexible time, and it's a whole bundle there. And so the labor market for these kinds of buildings by itself has become extraordinarily competitive, and our customers are stepping into that. And we're part of that offering because we want to build attractive buildings where people want to go to work with amenities. And so, you know, the labor piece is kind of redefining a little bit what we deliver to our customers.
I'm curious on that labor piece. You mentioned previously the municipalities, the resistance to losing a retail facility because of the lack of tax base if they have a retail tax. But I'm curious, is there a shift in thinking and the recognizing the jobs that the facility is bringing and the ability or the income tax from the employees and all of the supported industry around the facility? Is there any recognition of that as far as their municipalities? Are they shifting their sense of a revenue stream?
The real beneficiaries of the municipalities, directly and indirectly, is the property tax revenue. And so we're massive payers of property taxes. And when you hear the term property taxes, think schools, because schools absorb in most areas fully 40 to 60% of the property tax revenue dollar. And so we're wonderful for schools. We don't bring any children into the neighborhood, but we pay a massive amount of property taxes. So there's a strong recognition around the value of that. The income tax side is a little different because most of that benefit goes to the state and the feds, of course.
Gotcha. Well, and too, I know as the shift on the taxes there, it makes sense to be more of the property tax there. So I got that. So we've talked about some of the players and some of the lifestyle things that have changed as far as the ability to order something online. And you mentioned that a lot of the pandemic and some of the funds that were distributed by the government through the pandemic and that was this. And you also said that the pandemic kind of accelerated this, the change. If the pandemic did not happen and the funds weren't given to people the way they were, are the elements? Is it more of a technology thing, and that the people have kind of just accepted a new way? I mean, are people's buying habits changed? I know my kids, they would rather not talk to you. They'd rather just click a button and I mean, I've had to coach them like, go to the line where you have to talk to somebody.
Yeah, there is a generational swing there, but I think across all the demographic groups, the adoption of e-commerce prior to the pandemic, that adoption rate was running at about a 15% annual compounded rate, so about a 15% CAGR. Then the pandemic hit, and it accelerated that. At about 4 to 5 years of growth was accelerated into 2 years during the pandemic. Now the growth rate is leveled off because what happened was that pulled a lot of that adoption forward. And so that was not a sustainable rate, but it is all about behavior, consumer behavior. And why do we need to go to the store to have daily items brought to our or to go buy Pampers or ketchup? And so that creates a particular challenge for the omni-channel and e-commerce folks, because the kind of distribution that you do, if you're Walmart, when you have KitchenAid mixers that are brought in by the train load into Joliet, Illinois, then broken down to the truckload and ultimately the pallet load, and then the pallet size is delivered to the stores. That's a very different order fulfillment than having someone go on their phone and say, I want a KitchenAid mixer, a package of Pampers, a box of pens, and a case of Coke. So you see how companies are having to modify their supply, their customer fulfillment. The omni-channel folks in particular, where they've had that model that I described earlier, where they're bringing bulk to the stores and then the consumer walks in, versus being able to fulfill individualized orders. And so that's the transition that's been occurring, and different firms have a different take on this. Target and Walmart, for instance, have done a good deal of that fulfillment out of their existing stores, in addition to building some e-commerce specific distribution buildings. Amazon, as you know, is e-commerce only. So that's what they're set up to do. But every time I describe one of these models, it's a different set of material handling equipment, different set of labor challenges, and a different kind of brick and mortar that needs to house all that.
Yeah, as you were saying that, it just occurred to me that, in the, traditional model, you go to the store, you buy the three items, whether it be the mixer, the Coke, and the Pampers or whatever, and you leave, you put them in your car, you drive home. Now, if you're going online and you're click, 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 kind of thing, it may appear as one order because you submit it all as one order, but it just occurred to me that perhaps not all of those three items are coming from the same single location, because like an Amazon or even Walmart or whoever, they could have a number of mixers on the shelf in the community you're in, and maybe they have Pampers across town, and maybe they have the ketchup or whatever else it is you ordered somewhere else, and so that they're able to utilize all of their different points. And I know I had a situation where I had ordered some clothes or something. This is pre-pandemic, but I remember the size was wrong or something, and I went online or called to do the exchange, and I thought they're going to have me ship it back. They said, why don't you just take it to the retail store? And I found out I was part of the logistics for them. I was taking it to their retail store to restock their shelf, as opposed to the ship back and forth and that kind of thing. So as I kind of relay that, is that a reality? Is it, are the distributors, distribution network, or the retailers, are they now having to monitor inventory from all points and kind of watch the movement, to fill the need and or to return the product? Or is that
There's
become
an entire industry has grown up around reverse logistics, which is what that's called, what we would call returns. And it's massive, because as e-commerce and omni-channel retailing grow as a percentage of total retail sales, and by the way, that percentage is now well north of 20% of all retail sales, ex autos. As that grows, this whole universe around reverse logistics has to grow with it. And you just gave some very good examples. I know people who in their own lives routinely order 2 or 3 garments, maybe the same kind of garment in a different color or slightly different size, keep one and the other 3 go back. Well, where do they go and how do they get there? How does it get restocked? I've had one retailer I won't mention send us, we ordered something for my granddaughter. It was like a backpack or something. They sent us something completely different. And when we called to say, how do we return this? They just said, you know what, just keep it. We'll send you what you wanted, but keep that other thing, because it's cheaper for them just to let us keep that $50 backpack than it was for them to try to handle it. That's rather eye-opening. So I would say that those are challenges that are building for our customers, no pun intended. But the other challenge is, what are we going to do with all these cardboard boxes?
Yeah,
so you have all this fresh cardboard delivered to your home every week, and sure, we can recycle it, but how do we get to a place where we reuse some of that, or get to a place where we use reusable cartons? If someone can figure that out, that's the next billion-dollar business.
That's a great point, because I swear I'm breaking down more boxes now. I feel like I'm, back when I was in high school working at Kmart, and the unboxing, put the stuff on the shelves. You had to tear it all down, or all the boxes, and take them to the. They used to burn the boxes when I was a kid. They didn't even, there was no recycling. It was just get rid of the trash kind of thing.
Well, at least I think most people are diligent about recycling that. But one wonders what that market looks like. There's so much product coming in.
Yeah, because like you said, those boxes are there. I mean, it's a perfectly good box that I would ship something else in, or wrap a Christmas present or something in if I had a need for it.
Right.
But the just the supply is so high. That's a great idea, and a great point. I'm hopeful somebody figures it out.
We have a lot of
Uh,
bright people around. I think someone will unlock that key to that.
yeah, yeah. So uh, the move from kind of the brick and mortar retail to now more of the logistics model, and uh, the e-commerce model. How much of that do you feel like is driven, or does work from home uh, support that, or create that demand?
Yeah. So work from home, which I think we all agree was a byproduct of the pandemic, although there's always been a segment of the working population that has worked from home. That has made available some of the I should say made obsolete some of the existing, especially suburban office stock that's no longer attractive to companies whose employees either want to work from home full time or want to come into the office on Monday and Friday and work from home in the middle of the week. So my brethren in the office side of the real estate space are trying to figure out what that means for their business. But in the meantime, it means that a lot of Class B and C office buildings are obsolete. And the question is, what do we do with them? In the suburbs, potentially they could be torn down and repurposed. In the cities, there's been discussion of conversions to multifamily residential, which is that kind of stock that we all of our cities need. The challenge is the physical challenge of converting that, which we don't have time to talk about this morning. Those barriers are fairly high. To take an office building and convert it into apartments, it would seem like it'd be very intuitive, but the execution is difficult. So yeah, the work from home is the other main secular change that's driving the real estate business. The first being e-commerce, and the second being work from home. And sometimes those secular trends intersect, as they did for us at the Allstate campus in suburban Chicago in Glenview, Illinois. So that was a 232-acre corporate headquarters campus. Allstate made a decision during the pandemic that they were going to move to a work from home model, which made that the over 2 million square feet of pristine office space then became vacant. And because of the value of the land for logistics space, we were able to acquire the property, and we're in the process of converting all of it to a logistics campus, which I never thought, in the 10,000 times I drove by the Allstate headquarters campus, which is an iconic property in the Chicago area, it never occurred to me that I would live to see a day where industrial land would be worth more than Class A suburban office space, but here we are.
Yeah, that's wild. I'm assuming that the location of that's primary to the value for you guys. I'm assuming, is it near like an interstate exchange, or is that a
So it's right at the interchange of the Tri-State Tollway, which is I-294, which is the major north-south thoroughfare running through the Chicago suburbs up to Wisconsin, down to Indiana, at the Willow Road interchange. And so it sits right in the middle of some of the most affluent housing in the northern suburbs of Chicago. And there's 1 million people that live within a 10-mile radius of the campus. So when you combine that sort of scale at over 230 acres with that kind of infill location. It's really a generational investment for a firm like us. It's it's something that we're very, very excited about. I wouldn't know how to replicate that in any other major city in the country unless if you think about your regional mall, I guess in the Portland area, if you took like Washington Square and that no longer existed, that's the scale of the development that we're talking about.
Oh, no, it's just kind of blows my mind, because you get used to it being, what it is, and then to realize that's no longer in demand. Pretty weird.
We're in the process of demolishing. There's a large handful of buildings at over 2 million square feet in the aggregate, and the demolition has begun. And everyone from your Uber driver to your neighbor is talking about it because it's such an iconic property, and to see it come down sort of one bucketful at a time, I think, it's jarring for people, actually.
Yeah. Well, and like I said, the work from home kind of changed that. I think pre-pandemic, they probably would have never even thought about that.
I can't speak for Allstate because they've made their own public announcements, but one could imagine that if they had been thinking about that sort of change, that the pandemic was an accelerant. So the pandemic was an accelerant for e-commerce. It was an accelerant from work for home. Just two of the massive changes, but the two that I think about when I think about our little business.
Yeah. Now the whole work from home thing, I know that forever I've had friends and people, and I used to work, from the spare bedroom all the time. And that was when I had a outside sales job. And then the technology was there. I just don't think that there was the demand to use the technology and the scale, that we do now. I mean, here we are and, talking on Zoom.
Right.
But no, it's fascinating. Hey, Doug, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We look to see first if we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when those are not options, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, investors, interest rates, public policy, whatever you would like to identify, or whatever you consider to be the biggest risk. And again, for clarity, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Doug Kiersey, what is the biggest risk?
Well, it's interesting you should ask that question. A question that I ask myself and I ask our team when we're considering an investment is, what does our risk adjusted return look like? And so I know, or my investors know, if they want to put their money in the so-called risk-free investment, that's also known as a US 10-year treasury, that presently they can get a return of about 3.7% a year. Well, I'm taking a lot more risk than that. And so what kind of a risk premium do my investors and our company demand in order to take a number of risks? And here are some of the risks. The risk that we build these buildings and no tenants show up. So I'm taking demand risk. There's the execution risk of building the buildings. Can I build them on time and on budget? So I'm taking construction risk, although we try to mitigate that as much as we can. I'm taking interest rate risk because our construction loan is on a floating rate basis. So I have to be able to understand what that looks like over the course of the 3-year construction loan term. Then I'm taking long-term interest rate risk because if I put permanent debt on the project, what is that going to look like 3 to 5 years from now? And lastly, I'm taking valuation risk. So when I create this income stream, when I build these buildings and I lease them to great companies and they pay me rent and I'm creating this massive income stream. What is that income stream going to be worth 5 years from now? And that's really the biggest risk. So I can do all these things and manage all these risks, but I don't really know 5 years from now what that income stream is going to be worth, because a lot of that is reflective of the Fed's activities and where our interest rates going to be. So we try to skate to where we think that puck is going to be in 5 years, but that's the biggest risk in our business. So we can, taking all that into account, when we look at levered returns for a project like the logistics campus in the Chicago suburbs, we're looking for high teens and low 20s kind of pro forma returns with appropriate and conservative underwriting on each one of those stops that I mentioned. And so if my risk-free investment is 3.7% for the 10-year treasury, and I'm going to do all this, I want something in the teens at least.
No, a lot of risk you just identified there, and makes sense that you'd be looking for, a rate of return that makes it worthwhile. It's scary when you think about just that notion of the future value of what you're doing, and how important it is that you're attuned to what the Federal Reserve monetary policy is going to be, and that's interesting.
Well, in the prior part of the cycle, we could generate, just to make the math simple, $4 a year of return, and the institutional investors would pay me $100 for that property. They'd pay me $100 for a property where they would get $4 a year in return if everything went well. And so that's a massive inflation of asset values, which was directly the result of the Fed's actions since the great financial crisis, and certainly during the pandemic. And now they're unwinding that. And so now I may have to provide $6 of income to generate that $100 sale to the investor community. It's a pretty significant change.
Yeah, 50% additional return there.
Right. Which is okay. We can plan for that. But for those projects that are existing, where costs are fixed.
Yeah, I think that's really kind of the shift, is how do you adjust that base, or the basis there. I think the new projects where you've got it priced in from the ground and all of your other stuff, I mean, it makes sense. But the existing stuff, I get it.
Well, you hope that rents grow, and there's certainly rent growth in the U.S. logistics markets. We have historically low vacancies, and so supply and demand remains in a great place fundamentally for landlords, and we're going to probably see continued rent growth. But you can't grow rents fast enough to overcome the very steep increase in interest rates.
Right. No, I think that is the riddle we're faced with. So,
and as a consequence, a whole slug of projects that were kind of in process, that were just getting ready to start, have now been put on hold. And so that's going to suppress supply in late 23 and 24, because the pipeline's been disrupted, which will in turn, I think, grow rents in those years. And so when we think about how to navigate these cross currents, there's good news and bad news in everything. But what happens is you get caught short during the transition. That's where people get hurt.
Right. Nope. Good to have a strong balance sheet in these times of turmoil here. Hey, Doug, where can listeners go if they'd like to learn more or connect with you?
Well, our website, dermody.com, DERMODY.com, has everything you need to know about our firm, our history, the key associates, as well as information and a link to the project that I've referred to, which we call the Logistics Campus in Glenview, Illinois. And my contact information is there as well. So if any listeners want to email or phone, I'd be happy to continue the conversation offline.
Awesome. Well, Doug, I can't say thanks enough for taking the time to talk today. I've thoroughly enjoyed it, learned a lot, and look forward to doing it again soon.
It's wonderful, Darren. Thanks for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.